Today, episode 6, DEAD CLIC. But before we do that, let's just quickly run through what we've learned in the previous 5 episodes. We have learned that every transaction affects 2 accounts, and all our transactions are recorded in a T account. So here we have two T accounts. Debits go on the left, credits go on the right. Debits on the left, credits on the right. And the total of all the debits always equals the total of all the credits. Just say, for example, we did some sales. So this T account could be sales of $200. This could be a bank account. The bank account, 200 of sales. The debit on the bank is we debit 200. The sales we credit 200. They're equal and opposite. Both sides always balance. The 5th rule is every transaction goes into one of these 5. Belongs in one of these 5 categories. They're either going to be an asset, a liability, equity, income, or an expense. That's the 5th rule. Every transaction is in at least is one of these. The 6th rule is this: the accounting equation: assets equals liabilities plus equity. Now here's a question. How do we know on which side of a T account things are going up and things are going down? For example, in this bank account, we made some sales of 200. So the bank account went up. It's an asset account. It went up $200 and we put it on the debit side. Sales, they went up $200. We put them on the credit side. How can you tell the difference? Why do you put one on one side and one on the other? Well, there's a very easy way, a mnemonic. It's an easy way to remember. It's not an easy thing to say. So there's a very easy mnemonic to remember. Let's draw a big T account. This is a T account. And then all you need to do is remember the mnemonic DEAD CLIC. DEAD CLIC sounds a bit gruesome. It's not really. If you write it like this instead. So dead is on the debit side, this side. We're going to write dead like this on the left side of the T account. And we're going to write click on the right side of the T account. The left side, if you forget, the left side is the debit side. The D stands for debit. We can write it DR. The C from click is the credit side. And we can write that CR. Right, so back to DEAD. D-E-A-D. All it stands for, the account types. Remember we had those 5 account types. They're all here. We had assets. We had liabilities. We had income. We had expenses, and we had capital or equity, and drawings, dividends. Accounts on this side, if you enter them on this side, they increase. If an account is a liability or income or capital and it increases, you put it on the credit side. So expenses, assets and drawings, if they increase, you put them on the debit side, and liabilities, income, capital, if they increase, you put them on the credit side. Really straightforward. What happens though, if you want to decrease them? Let's go, can I write this on here? Let's say we have another T account. This is the bank account again. And let's say we have those sales of 200, remember? So the bank's an asset account. Assets, dead, assets go up on the debit side. So if we have $200 of sales on the bank account, we show it on the debit side, 200. If we have the sales account, because every transaction has 2 footprints, remember, in 2 separate accounts, at least 2, could be more. Let's look at the sales from scratch. Sales is income. Income is the I here. It's on the credit side. So if sales go up by 200, it goes on the credit side. So we would enter this transaction in sales on the credit side. So this is one transaction, debit the bank, credit the sales. We are debiting an asset and we are crediting the income. So DEAD CLIC shows you on which side you increase. Let's just do a couple of examples. Let's say we have a bank account. There's the bank. We're going to make some sales. Oh, there's a sales account. Remember, DEAD CLIC, DEAD CLIC. Just remember that. We're going to make $1,000 of sales. Sales is income. It goes up on the credit side. So $1,000 of sales on the credit side. The other side of this transaction would be the bank. The bank goes up. It's an asset. It's the A here. So we'll do 1,000 here. Debit 1,000, credit 1,000. It balances. Let's say we have some fuel. And we've been down the garage and we've bought $100 of fuel. Fuel's an expense, it goes up on the debit side. So we'll put $100 here, paid straight out of the bank account with a debit card. The bank's an asset. Assets are also on this side, they go up on this side, but we've spent $100 from the bank, so it's gone down, so it's on the opposite side of this, so it's 100 here. That's the fuel. Let's write that in there. Fuel 100, credit the bank, debit the fuel account. It balances again, debit and credit balance. And let's say we have another payment, insurance, for example. Again, that's an expense account. It's the same on all expense accounts. Let's say the insurance is $200 that we've had to pay. Insurance is an expense. Expenses are debt is on the debit side. Insurance has gone up. We put it on the debit side. The other side of that is the bank, just like the fuel, it's come out of the bank. So it's the bank is an asset. Assets go up on the debit, they go down on the credit side. So we've spent 200, we have to put 200 here in the bank. Very straightforward, everything balances, it's very neat. What's the bank balance, by the way? The way we do a balance on T accounts is which side is the greater? 1,000 is the greater, so we put it on the total of both sides. But this doesn't add up to 1,000, so we have to put in a balancing figure, 700 to balance. So 100, 200, 700 equals 1,000. That's a balance, and we'll say we'll carry that forward. And then under here we write balance brought forward is 700. So it's a bit tight there. So the bank ends up with 700, fuel's 100, it all balances, it's all easy, it's very tight, it's very logical. Okay, didn't I say we had 5 types of accounts, and haven't I just written 6 on here? Expenses, assets, drawings, there's 6 there. Well, in accounts, occasionally you get something called a contra account. Contra account goes with an account, but it's the opposite of it. So drawings is a contra account to capital. Basically, it means if a sole trader takes money out of a business, which is called drawings, this D can also stand for dividends. Or if a company issues dividends to its shareholders, so money is coming out of the company, that is not an expense. That's a reduction in the profit. It's a reduction of capital. So capital is a credit. It normally goes up on the credit side. Drawings are opposite. If you increase drawings, they go up on the debit side, which in effect is reducing the capital. So it's not a separate type of account, but it's really handy to have it here so that you'll remember drawings are opposite capital. So DEAD CLIC. Let me just show you how the accounting equation is the sum of all the T accounts. Really, we could extend this T account, this center line, up through here. Assets have a normal debit balance. Liabilities and equity have a normal credit balance. And so assets equals liabilities and equity because the debits always equal the credits. Look, DEAD, it stood for, let's have a look, DEAD CLIC. We know these accounts will go up on the debit side, these will go up on the credit side. Assets is this one. Assets equals liabilities, that's this on this side, plus equity, which is capital. What about these though? Do you remember the previous episode we wrote there are 5 types of accounts? The 2 that are not shown in this equation are income and expenses. If we take expenses away from income, income minus expenses equals profit or loss. The profit, we then took it and put it into equity. So income actually increases profit, which increases equity. So income increases equity. We'd stick it over here, income. It's the I on click, income. And expenses reduce the profit and reduce equity. So they're opposite. So expenses would normally rise up on this side. Drawings are not an expense, or dividends. So drawings or dividends, these are not an expense. They're not one of these. Drawings come out of profit. So profit minus drawings then goes into equity. So drawings reduces equity. It's on the opposite side. That's why drawings are over here. So it makes complete sense. The accounting equation, assets plus expenses plus drawings equals liabilities plus equity plus income. It all falls out and balances. Just a quick word about DEAD CLIC. It's not an accounting rule, term, or whatever you want to call it. DEAD CLIC is not part of accounting. DEAD CLIC is a mnemonic. That's all it is. You'll never get tested on it if you're doing an accounting or a bookkeeping exam. They won't say, can you explain DEAD CLIC, please? It won't happen. It's just a mnemonic to help you understand on which side of the T accounts go up and which go down. That's all it is. There are other mnemonics available. Dealer is one. Lots of people, especially in America, use dealer. Basically, they have DEA as, I can't remember what it is, drawings, dividends, expenses, assets, liabilities, equity, revenue. So slightly different terms. I much prefer this because it shows you straight away which is the debit side and the credit side. Especially when you're beginning bookkeeping, accounting can be really hard, or really easy to forget which side the debit is and the credit. Here it is, debit, debit, credit. This doesn't tell you that. Also, it's got 2 E's, equity and expenses. Could get confused. There are others as well. They're not part of accounts, they're not part of bookkeeping, they're just mnemonic. Just a aid memoir.